Welcome to Market Catalyst. I'm Ines Ferre. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, consumer confidence data crossing the wire. Find out how consumers are feeling this holiday season after November's reading was the second lowest since the pandemic. Plus, the top restaurant stocks heading into 2026. We'll take a look at the names that are best positioned to weather the ongoing affordability crisis. And the outlook for venture capital, how investment is rushing into AI and what it means for future IPOs. That's all coming up on this hour of Market Catalysts. Taking a look, though, at the major averages, we are seeing flat markets right now with the Dow, the NASDAQ, and the S&P 500. That hotter than expected GDP print that came out, markets not liking that this morning. Russell 2000 down 0.2%. And taking a look at the U.S. Treasury, that's up 7 basis points to 4.20, and the U.S. dollar index below around 98. Looking at the sector action where we're seeing some of the movement, you've got utilities, communication services, also financials that are in the lead. And over on the NASDAQ 100, some movement that we're seeing with Alphabet up 1%, Amazon, Apple, some of the Mag 7 stocks, Tesla down 0.4%. I am curious to see the crypto space because we have been watching Bitcoin down more than 3% over the last 24 hours, around 86,000. Look, Bitcoin has not been able to really get past the 90,000 level over the last several sessions. Bitcoin not liking what we saw with that GDP print either, and what that could mean for Fed cuts next year. Ethereum also down around 29,000 per token. But let's take a look at commodities because that's where we've seen some of the action over the last several sessions. Oil relatively flat, but take a look at gold futures. Gold hovering near all-time highs, although we have seen a little bit of a decline this morning. And then also silver futures also looking at all-time highs over the last couple of sessions. Well, consumer confidence data just crossing the wire, coming in below expectations at 89.1. Economists had forecast a 91 reading. Still, it's higher than November, which was the second lowest reading since the pandemic. Joining me now to break down the numbers, Yelena Sholyetba, the Conference Board senior U.S. economist. Yelena, what's the big takeaway picture that we're getting from today's reading?
Good morning. We are seeing that consumers are feeling worse and worse about current situation. So we see that the current conditions index declined significantly in December, the months where we making all our holiday shopping, and I think that is telling us that we should not be overexcited about the GDP numbers we received earlier this morning. So there's a big contrast between the actual data, which is lagged, and the more forward-looking index of consumer confidence. I think we should be expecting a little bit of a slowdown going into 2026 based on these numbers.
And Yelena, one of the big themes that we've talked about this year has been AI and AI impacting jobs, unemployment 4.6%. I mean, what can you tell us about how consumers are feeling about the prospects of finding a job?
Well, they are not feeling good about it. So we have a measure of labor market sentiment here, and that continues to flag. The labor differential, which is the difference between jobs plentiful and jobs hard to get, continue to decline. Also, consumers are feeling much worse about their family financial situation. That dropped into the negative territory for the first time in 4 years. That is just telling us that consumers feel more strained from high inflation, even though maybe it's not rising at a fast rate anymore, but prices continue to be elevated, and that is affecting consumers' assessment of their financial situation.
And what about demographics? Because we've seen with confidence readings that younger consumers are maybe feeling a little bit more optimistic. You've got the 55 plus cohort that's feeling less pessimistic. How has that trend played through in this reading?
Well, when you're younger, you always feel more optimistic. That's my takeaway. But
True.
the declines in consumer confidence have been pretty broad-based across demographics, across income levels, and quite frankly, across political affiliations as well. So we see that broad-based kind of deceleration, declines in consumer confidence. That is just consistently been, at odds with the data that we've been getting. But our take is that consumer confidence index is more forward looking. So we do expect some slowdown in economic growth in the beginning of next year as tariffs and tariff inflation actually materializes in consumer prices to a larger extent.
And talk to us about consumer short-term expectations. That would be for income, business, labor market, because I'm seeing here a reading of 70.7. That's higher than November's reading of 63.2.
Well, yeah, the months-on-months movement can be quite erratic, but overall, expectations index remains at a pretty low level, actually consistent with much weaker economic growth overall. So we need to look at the trend in overall index and different components of that. And unfortunately, the December report is pretty weak overall.
And I'm curious, gasoline prices are at 4-year lows right now. That's a significant saving for consumers. I'm curious if your surveys if consumers are citing reasons in your surveys, because you are seeing falling prices for driving fuel, but I'm not sure that that's enough really to impact consumer confidence.
Consumers are still talking about high prices, tariffs, and politics. They're concerned about these things. And inflation overall is what's driving consumers' assessment of how they look at inflation. And I think they are still not happy about it. And, gasoline prices at a lower level, it's a great thing. It always helps, but it's not everything. Grocery prices are still elevated, and that is definitely affecting consumer confidence.
And what can you tell us about the outlook for 2026? I mean, you mentioned inflation expectations. What are consumers looking at when it comes to 2026 and beyond?
Well, consumers are really worried about their financial situation. That affects growth in income. That is will be affecting growth in consumer spending. Q3 numbers this morning were absolutely robust in terms of consumer spending, but will it last into Q4 and into 2026? The data that we received from consumers on consumer confidence and other indicators are suggesting that consumer spending will slow down going into 2026. And this is our projection. We're obviously not expecting a downturn or anything close to that, but we think that consumers will become more cautious going into the next year, given the current level of prices.
Thank you, Yelena. Happy holidays and
happy holidays.
Thank you. Coming up, we'll run the numbers on the tax picture for Americans in 2026. Stay tuned. You're watching Market Catalyst. Tariffs and stubborn inflation have made it a lot more expensive for Americans to deck the halls in 2025. Let's check in on what the tax picture looks like for Americans trying to keep up to budget in 2026. Joining us is Erica York, Tax Foundation Vice President of Federal Tax Policy. Hi, Erica. Thanks for being with us. Let's break down the impact of the big, beautiful bill that was passed this year. And what does that mean for families in 2026? Let's start off with the child tax credit, for example.
Yeah, the child tax credit received a $200 boost to the maximum amount. And recall that it was scheduled to be cut in half going forward starting in 2026 because temporary changes from 2017 that boosted it were going to expire. So lawmakers extended that underlying child tax credit and gave it an extra boost. And they made that change effective for 2025. So when parents go to file their taxes here in early 2026, when the filing season opens, they'll get that boost on the tax return that they file for 2025.
And how about for somebody that is working as a service worker? What does the money picture look like for them?
Yes, so people who earn tipped income will be able to deduct that on this tax return that they file now. That was another one of those somewhat retroactive changes. So that took effect for 2025. And taxpayers will benefit from that. They will also benefit if they earn income through overtime pay. Both of those will be active when people file their tax returns. And so they can expect to see a larger tax refund or even a smaller tax liability due if they have those types of income.
And what about seniors? Are they seeing a tax benefit for 2026?
Yes, there is a new $6,000 deduction per senior. So that is available to seniors regardless of whether they itemize or take the standard deduction, as long as they meet the income thresholds on that, which prevents higher income seniors from benefiting. They will get to take that $6,000 deduction per filer. And that's one of the larger tax benefits that's available for this upcoming filing season.
And Erica, we just got lighter consumer confidence figures for December, and a significant part of that has to do with the effects of tariffs. What's your calculus on how much tariffs are costing households?
We have estimated that this year in 2025, per U.S. household on average, the tariffs amount to about an $1,100 burden. And that's true whether the tariffs show up in final consumer prices or whether they remain a hidden tax on the economy. The question is not, do consumers, do workers, do businesses pay the tariffs? It's a question of how do they do that? Are tariffs remaining a hidden tax at the business level, so weighing down on hiring, weighing down on wage growth? Or are they more obviously being passed forward to consumer prices? In both cases, it's Americans who pay, and we estimate this year in 2025, that's an $1,100 burden. It grows to about $1,400 next year if the tariffs remain in effect for the full calendar year.
So there's been some tariff exemptions this year, but your research says not so on holiday decorations, specifically Christmas ornaments and lights. So we're looking at a graphic right now. We want to show you this graphic that customs duties on Christmas lights alone have risen to $45 million this year. Erica, this is supposed to be, a happy time of the year. This, how is this, do you think, weighing on people's household finances? The fact that their lights, their Christmas trees, their ornaments are costing more.
Yeah, whether you're purchasing new lights, you need to upgrade your artificial tree, you're trying to buy a nativity set, all of those things are being hit with tariffs, and they have climbed from I think like the graphic shows a rather small amount in 2024 to very large numbers. Upwards of $500 million in tariffs have been paid, and that's just through the first 9 months of 2025 compared to 2024. This makes it more expensive. Whether it's a business that's trying to sell these goods to consumers and it faces higher prices, maybe it can't hire as many seasonal workers because costs have gone up just to stock the shelves, or whether that shows up in the sticker price that we pay. It makes things less affordable, which means we purchase less, which means ultimately we're having a lower standard of living because of this higher cost that's applied to what has no real rationale to have tariffs in the first place. These aren't goods related to national security. These aren't goods related to national emergencies. They're holiday items, and they cost more because of the trade war.
What about the toy picture? Because I will tell you, I went to the store looking for Santa presents for my daughter. They're pricey.
Yeah, toys are one of the things that have had tariffs applied. They do not have an exemption. And I think this is interesting because in Trump's first term, they were also considering putting tariffs on a host of consumer goods, including toys and board games. And at that time, the president decided to delay imposing those tariffs ahead of the holiday season because he didn't want consumers to have to pay more to put Christmas presents under the tree. This year, I guess that is not the case, and we are paying more. Toys, board games, my kids wanted scooters this year. All of those things have tariffs applied, which is going to make them more costly.
So between the new tax rules and a potential tariff rebate next year, that's being talked about a lot. Will those two elements, so to speak, be enough to offset higher costs for households next year? A tariff rebate and the tax savings?
So I think a tariff rebate is not really on the table. The president and his administration have spoken a lot about this, but to actually, implement a new rebate policy to send checks out to people would require an act of Congress, and I don't think that's high on the priority list for Congress. People will benefit from the tax cuts that Congress passed last year, both when they go to file their taxes in the upcoming filing season and get larger refunds, and then going forward, the Treasury Department will adjust withholding tables so that lower taxes are withheld from each paycheck, so a little bit higher take-home pay with each paycheck. And people will notice that. Depending on a person's situation, that will really determine whether their tax cut outweighs their tariff burden. But the tax cuts in aggregate do add up to a lot larger revenue impact than the tariff hikes have. So it makes sense for most people that they'll come out ahead when you weigh the combination of tax cuts and tariffs. But I think an important caveat to that is that for the most part, the tax cuts are continuing status quo. Like I mentioned up at the top, a lot of what Congress did was extend expiring tax provisions. So from a personal standpoint, if your tax bracket remains the same year to year, if your standard deduction is close to the same with a small boost, you're not going to feel much different, but you will notice the tariffs. So from a sentiment standpoint, people may feel worse off, even though from a budgetary scoring standpoint, it looks like large tax cuts.
You know what one of my friends says is to buy 50% off after Christmas, those ornaments. So thank you, Erica, and happy holidays.
Thank you. Happy holidays.
Coming up, restaurant stocks to add to your tab in the new year. That's next on Market Catalyst. The restaurant industry has faced several headwinds this year, including stubborn inflation and wary consumers. Mizuho estimates a 10% shift away from dining out toward eating at home. But there are still bright spots for investors in the sector heading into 2026. Nick Setyan, Mizuho Managing Director and Senior Equity Research Analyst covering restaurants, joins me now. Nick, thanks for being with us. Let's break down first the trends that you're seeing in your research, specifically the shift away from restaurants to grocery and supermarkets. Tell us about that trend and what's behind that.
Well, the primary driver is the outsized pricing within QSR Burger, and QSR Burger is 25% of all restaurant industry sales, and they've taken over 50% pricing since 2019, versus grocery inflation of just around 30%. And so wage inflation has been right around 30% as well, and so that incremental pricing has resulted in customers shifting away from particularly QSR Burger to both grocery and other restaurant categories in order to maximize their dollars.
And among the fast food chains, so which are better positioned to weather this and maybe thrive in the affordability crisis that consumers are facing right now?
Sure. So within QSR, we look at the pizza category as best position, and within that, Domino's Pizza is a top three pick for us in 2026. And they've taken less than 30% pricing, about 27% or so since 2019. And they're now almost 15 to 20% cheaper than QSR Burger. And the worst position to us is Wendy's.
And why? Just because of the QSR Burger?
Well, within QSR Burger, they're one of the names that has taken outsized pricing, but they also do not have currently a permanent CEO to really navigate the value wars. Number one. Number two, historically, they're a premium positioning within QSR Burger, so it makes it a lot more difficult to really come up with an effective value strategy. And within QSR Burgers, for example, McDonald's, they're probably the furthest along in having come up with an effective value strategy. We think Wendy's hasn't even started really answering the question.
And talk to us about that value strategy. What role does the value meal play into the trends that you're seeing right now?
Right. So we're actually seeing an accelerating, value war across restaurants led by QSR Burger, and that's being led by McDonald's. And really the goal is to try to suppress check growth, to bring that more in line with grocery inflation and really try to regain some of those lost customers. And so, QSR Burger, starting in early 2024, has said enough's enough. We want our customers back. And through value, an aggressive value stance, they're trying to regain those lost customers.
And what about the protein craze that we're seeing within the eating out space? Talk to us about which companies are sort of better positioned to meet that demand from consumers.
Well, what we've seen is the steak category within casual dining has continued to outperform. That's a multi-year trend that's sustaining. If anything, it's probably gaining momentum. Number one, yes, it's benefiting from in protein trend, but the relative value versus grocery beef inflation continues to expand. So, you go to a Texas Roadhouse, you can get, a ribeye dinner with two sides for $30. The ribeye at the grocery store now costs $23. And you have to cook it and add the sides. So that relative value proposition has been expanding. So names like Longhorn and Texas Roadhouse continue to benefit. And surprisingly, coffee is probably the one place where adding protein has actually been a pretty on-trend thing to do, and it's benefiting their same-store sales growth quite a bit. We're even going to start to see Starbucks go that route.
Okay, I've yet to try the protein in my coffee, but I am a coffee lover. So let's talk a little bit about that coffee space because it's a competitive space and labor costs are high. We know the turnaround that Starbucks is going through and also making it sort of a more personable sort of environment, a service, but really dedicated to service. Talk to us about which companies you're seeing as better positioned in the coffee space going into 2026.
Sure. So Starbucks, to us is actually unfavorably positioned, and Dutch Brothers is probably the best name within coffee, again, in our view. And it goes back to, the view that Starbucks has taken over 50% pricing since 2019. It's gotten way too expensive. Its peers, like Dutch Brothers, have taken only about, again, 30% pricing in line with grocery. And Dutch Brothers is now at 15% plus more attractively valued relative to Starbucks, apples to apples, latte to latte, frappuccino to frappuccino. And that's resulting in some share gains for some of these smaller peers versus Starbucks. Starbucks is busy trying to convince the customer that they should be paying a premium for what's a premium coffee, and now they're trying to shift towards a more premium experience. And I'm just not convinced that in this environment, that's a message that's going to resonate.
Interesting take. Thank you, Nick. And happy holidays and New Year as well.
Thanks for having me. Happy holidays.
Coming up, it has been a big year for Circle after a successful IPO and the approval of the Genius Act. Here what the CEO told Yahoo Finance about his 10-year vision for the stablecoin leader. Stay tuned. You're watching Market Catalysts. Longtime stablecoin proponent and Circle co-founder and CEO Jeremy Allaire sees a future where Circle's technology is embedded in the very fabric of the internet and wider financial ecosystem. Here's what Allaire told executive editor Brian Sozzi in an exclusive interview on his Opening Bid Unfiltered podcast.
I think to bet against the U.S. economy, I think is challenging. There is no better economic system in the world right now than the U.S. system, and so the real question is the debt sustainable? That's a reasonable question. And look, I'm very much of the view that you have to deal with both issues, meaning you have to deal with the amount of spending and you have to deal with the amount of tax receipts. And actually, the fastest way to grow tax receipts is to grow the economy. And so I think a focus on growth in the economy and on bringing in investment into the country and on investing in the strategic industries that are going to fuel that growth is critical. And I think we're seeing that happen. It's a timing question, right? If you were talking to Secretary Besson, I think he'd say something similar, which is, we're going to get productivity gains out of this incredible investment that's happening in AI. And this is sort of the AI bubble discussion as well, which is, when does that happen? But me sitting here as a technologist looking at it, it seems very clear that over the next decade, we will see extraordinary productivity increases in the global economy. Yes, the U.S. economy as well, and U.S.-based companies will benefit from this massively, but we're going to see these productivity gains, and productivity gains drive real growth.
It doesn't sound like you're worried about an AI bubble. If we're going to get this much productivity because of AI, there's no bubble here.
I don't know. I mean, look, bubbles are a natural phenomenon in markets and in technology cycles.
And tulips.
Well, in the industrialization of the world economy over the past couple hundred years, right? There were many bubbles in railroads, bubbles in electricity, bubbles in so many other things. And look, the amount of investment that's happening for these 5 to 7 to 10 companies, if you count China and everything else, right? Is not everyone's going to win, right? So you're going to have some winners, you're going to have some losers, et cetera. But the real question is how quickly does the infrastructure unlock economic velocity? And so I'm very focused on that, and we're very focused on that. In fact, it's critical to Circle's strategy because we believe that economic OSs, like what we're building with ARC, we're designing those for the agentic economy. We're designing those with the assumption that over the next 3 to 5 years, a huge amount of the economic activity, the work, the labor, the coordination, the value exchange that's happening in the world will be executed by AI and will be executed by AI agents. And we need a different paradigm, a different economic infrastructure paradigm for that. And we're designing for that. And 3 to 5 years, you could have a bubble burst before that. Yahoo has lived through multiple bubbles as well.
And now we're rocking.
Yeah.
We're rocking here.
Yeah, no, that's great. And the internet bubble, kind of there was overspend on CapEx, and then it got absorbed as the technology got better, and you could do a lot of the things that people thought you could do in 1998 that you actually couldn't do. You could do them in 2004.
Look, you've been doing this. You founded the company 12 years ago. Clearly, you saw something happening down the line. Maybe I end it on this. Where is Circle 10 years from now? What is your vision?
Well, I think I hope that we're part of operating a major new infrastructure layer of the internet that we are building and operating, but I view what we're doing as something that it involves a lot of stakeholders, that involves a lot of whether it's developers or infrastructure companies or financial companies, like that we're building something that is running a substantial portion of this new economy, that the new economic activity that is natively running on the internet and is natively running powered by AI and is this extremely high velocity economic system, that we are foundational to the infrastructure of that. And I really would love to see that. And I believe that in 10 years that these new forms of money that we've been involved with, stablecoin money, and now the sort of these tokenization more broadly, but that these new forms of money and assets are a much larger part of the total amount of value, financial value in the economic system. And ultimately, we want to help create applications and utilities that make the financial world, at least, safer, more global, more innovative, more inclusive, and higher velocity. Like, I think our mission is to increase global economic prosperity through the frictionless exchange of value. And exchange of value is a concept that people often hear and they think, oh, you're talking about payments. Well, no, I'm actually not. Like, value exchange is I am in a labor contract with you, and I'm going to work for you, and I'm going to give you my labor, and you're going to give me income. Or value exchange is I'm going to sell you this product that you need to build your product, and there's value exchange, right? Value exchange is I want to borrow from you, and you're going to lend to me. There's so many types of value exchange. Where value exchange is I'm going to invest in your project and be a stakeholder in your project, and as the project generates returns, I'm going to get a return as well. So there's so many types of value exchange. We want to see, frictionless value exchange at a scale that we have frictionless information exchange and frictionless communications and frictionless commerce and frictionless software distribution. We want frictionless value exchange, and that can happen in 10 years. And because I think that can happen, and it can have the same kind of, like in these other areas of the internet, these sort of like million-x increases in the output of the thing, the amount of communication in the world, the amount of information in the world, the amount of software in the world. It's like a million times larger than it was before the internet transformed it. So the amount of value exchange that can happen in the world, I think, can like million-x. I don't know exactly what that looks like, but it can like million-x. And that, what that should mean is that global prosperity has increased, that we have played a role in driving economic velocity. And as I like to say, economic velocity is the lifeblood. It is the core of growing prosperity. And so that's what we're trying to do. We want to play a big role, and I view Circle as a company that we really want to work with everyone. And so hopefully something like that will emerge.
Well, I will just say this before I let you go. I encourage all viewers and listeners of this podcast or vodcast, whatever you want to call it, go back and read Jeremy's letter on the prospectus. These are the types of founders you want to get to know, the ones you want to trust and bet on. I mean, Jeremy is one of the most trusted people in this industry. Go back and read that letter, take notes. Hit me with some comments. I'm curious on what your thoughts after you read something like that. Jeremy Laird, thank you for joining us here. I appreciate it.
Coming up, the outlook for venture capital in 2026. Stay tuned. You're watching Market Catalysts. AI has been a primary driver of the stock market this year. And in the VC world, to talk to us, we are seeing AI. And right now, we have with us Ken Stanford, who is going to tell us a little bit more about Kyle Stanford, from PitchBook, Director of Research for U.S. Venture. Kyle, thanks so much. Talk to us a little bit more about AI and what we're seeing with AI. How does the IPO picture look like going into 2026?
Sure. Yeah. I mean, I think there's a lot going on with AI. And so, getting deep into that is going to be really tough. But what we've seen really from investors is that they aren't looking to touch much outside of AI. We had 40% of deals this year in 2025 were AI deals. 65% of the capital invested was into AI companies. Obviously, you have OpenAI and Anthropic really boosting those numbers. But the market has shifted from kind of your SaaS based investment theses to AI, right? And so AI, again, is not going to be this singular sector. It's going to be in life sciences, it's in fintech, it's in enterprise SaaS, it's kind of everywhere now. And I think the more that expands, You're going to see companies that aren't harnessing AI as their kind of fundamental business story having a really difficult time raising capital, right? And you talked about the growth of the public markets on the backs of AI. We have GDP growth starting to accelerate through in Q3 on the back of AI, and so I think 2026 is going to be a very fast investment environment for AI companies in VC and a really strong looking market for venture capital overall.
Kyle, looking through some of your research mentions a quality gap in the market. So what are some of the characteristics, for example, of the winners raising outsized rounds and preparing for exits versus those that may be lagging or struggling?
Sure, right. I think you hear a lot about ARR right now. And you see some of these AI companies that are maybe 2 or 3 years old driving huge growth in their ARR figures. And so, what used to be, raising a Series A on a 1 million ARR figure is going to be much higher now. So the KPIs that these companies are trying to get to and benchmarks they need to hit before they receive investment is really, really high. Right, we do see really strong investment up through Series A. At Series B, you start to see this kind of cliff forming, where you see companies really starting to accelerate their growth there, raising very outsized rounds, and really kind of capturing the growth capital in the market. And the companies that are struggling are having a tough time to raise. So, I think where the benchmarks got higher in 2022, now they're even higher and kind of supercharged because of AI.
And one of the sectors that has seen a number of IPOs this year has been the crypto and the broader fintech space. For example, Circle's IPO that came just before around the time of the passage of the Genius Act. So are these IPO windows sort of coinciding with policies and regulations? And if so, which sectors or companies would benefit from that policy or regulation coming in 2026?
Yeah, and I don't think it's just crypto. We've seen a lot of the IPOs in 2025, and the expectation is for it to stay the same in 2026. Following these administration policies, right? You have crypto, you have AI, you have defense and space companies that are going public, all following kind of the pathway that the Trump administration has laid out. Right. Obviously, crypto was the big investment in 2017, 2018, up through 2020. Now, with the regulations starting to come forward and help to kind of bolster that floor, I guess, for crypto, you start to see those companies like Circle going public. I think next year AI is where we're looking at. We also think defense tech companies and someone like Anduril, SpaceX has obviously talked about their 2026 IPO, and those are going to follow along those Trump administration policies and receive the tailwinds that those policies are providing. Headwinds is going to be life sciences, right? We have seen life sciences have a really difficult 2025. I think whether it be from early stage financing to potential price caps is all going to have an impact on that future return expectation. So life sciences has had a pretty difficult year this year, and next year will probably be very similar.
And what about the hard to reach tier of IPOs that may run well into the hundreds of billions, the mega unicorns, if you will? So which companies do you see at the top of that list that could be a possibility for next year?
I mean, it's tough to say, right? You obviously have SpaceX, who's going out and saying that they're ready to IPO. Stripe and Databricks have been a little less forthcoming with their IPO plans. They're probably all possibilities, but I think SpaceX is going to be the one that we're obviously know is should be the expectation. But I think it's also possibility that none of those companies go public. I mean, SpaceX might, but Databricks and Stripe have a seemingly unlimited amount of capital in the private markets to raise. And so if they need $2 billion or $3 billion for growth, or they need $10 billion to get liquidity for their early investors and employees, I think that's still there in the private market. So there's not this mega incentive for those companies to go public in this market.
That would be something to see if SpaceX did go public. Quite a lot of interest in that. Thank you so much, Kyle, and happy holidays.
Of course, you too. Thank you.
That's it for Market Catalysts. I'm Ines Ferre. Thanks for watching. More Yahoo Finance ahead. Stay with us.